Hello, this is Kirk Spano. Monday, October 20th, 2025. We have our options expiration update for October of 2025. We are going to talk about a couple of stocks that got assigned to us with cash secured puts, a couple of cash secured puts that expired, some covered calls that expired, just all kinds of good stuff. Touch on short term market moves and just a couple of ideas. I did put out the quarterly game plan and outlook yesterday, something like that. So we have the Q4 outlook and game plan. We talked a lot about this last Wednesday, so I'm not going to go through it too much. But the short story is everything is really lining up like 2021 going into 2022. I had wondered if this year would be like 2018. Unless we sell off hard at the end of the year, it looks more like a 21-22 setup, not a 17-18 setup, and that's fine. We are getting a rally today off of last week's volatility going into the option expiration, and that is setting up quite a bit of expansion of market breadth with the small caps and the non-profitable companies leading. So I just want to take a look at this. I don't have the updates yet, but that's on purpose because I didn't want to put them on this call. The Arrow, which is a drone company, options were assigned to us. So we have a net cost, at least I have a net cost of 17.25 on Arrow, and it has jumped today. Normally, when we get a jump after options expiration, that means that we're probably setting up for a rally that'll last a month or two. We are looking at an expansion in breadth that is likely to culminate in the end of this bull cycle. Now, how low does the bear market next year go if we indeed get a bear market, which I am putting at 60% that we get a run-of-the-mill bear market? About 10 to 20%, though, that we get a really horrific event, 10 to 20% that it just keeps going up a ton, 10 to 20% that it chops. But I do think that the overwhelming likelihood is between a regular bear market and a horrible bear market. That's 70 to 80% likely next year. Everything is setting up that way with regard to the second year of the presidential cycle, the way the monetary system is working. If you've been paying attention, the repo market got a little bit of a bailout over the weekend. The banks are pledging as collateral mortgages. I mean, mortgages. Usually they pledge treasury bonds. So the banking system has some stress right now. I think that is the culmination of the commercial real estate extend and pretend, the fact that the basis trade that was helping to support the fixed income markets is not as strong as it once was. The basis trade is the hedge funds that stepped in place of the banks to support the treasury market a few years ago. And with the bank reforms that we talked about, several months ago, they're hoping that the banks get back into the U.S. Treasury market. If those things play out and the banks support the U.S. Treasury market, instead of supporting lending, which is what they've been doing for a year, that's why the money supply has gone up, then that is a headwind to money supply. So we have competing forces here for where the money goes. And if the government starts sucking up a lot of the money, given that we blew out the deficit again and the tariffs haven't come close to paying the bills, then we are probably going to see a bit of a credit crunch, which is what I've been saying all year, that we should expect somewhere between the end of this year and into next year. It does not look like it's going to happen this year. However, stranger things have happened, right? So as good as it looks today, as sunny as it seems today, you don't know when a storm is going to roll in. Everything going on with China is pretty in flux. And I still think that the international community is going to jam it to Trump a little bit next year during the midterms. So we will have to see what happens. There really just hasn't been that much impact from the tariffs from the standpoint of revenue collection. Was it $200 or $300 billion? That's a drop in the bucket. That is in fact inflationary, but the fact that we haven't seen inflation pick up should be a warning to you. If an inflationary policy doesn't create inflation, that just means that we're getting a slowdown first, which in fact is what's been going on. It turns out that depending on whose data you read and how you interpret it, between 50 and 90% of the growth of GDP this year has been AI related. I think it's 90% if you stretch that out to, loosely connected companies, 50% if you really focus on the more directly connected to AI players. I still like the way things are going to turn out here in the very long term. I don't think we blow ourselves up. I don't think the aliens come for us. However, transitions are sloppy. Transitions cause angst. Angst causes stock market corrections. If there's not a credit crisis next year, we're just going to get a run in the middle bear market. If there is a credit crisis next year, we're going to get massive QE. Either way, we come out of it. And I think that's what you have to keep in mind. So from a tactical perspective, you always want to be looking for your best ideas and where you can get them a little cheaper with a bigger margin of safety. As you know, I love selling the cash secured puts 1, 2, 3, sometimes 4 months out, so that I always have something rolling off and having new cash available every month. So several of our cash secured puts expired, several were put to us. That means that of the amount of money I have in cash, some of it is no longer holding the cash secured puts, which means that I can do something else with that money. And I have people who don't know how cash secured puts tell me, but now you're not making money on that money. Yeah, but I got like a 30 or 40 or 50% annualized return for a month or 2 or 3. If it takes me a week or 2 or 3 or 4 even to get that money reinvested, that's okay. So we had the Arrow put to us. We had some Enovix expire and a few other stocks that were put to us and a few others that expired. So I will have this updated. It is sunny and warm in Milwaukee, and my garden is still looking pretty good, but it's going to be cold and rainy for a week. So I'm going to take that down at the market close, go do my gardening at about 3 p.m. And I am also working on the punch card stocks. As I discussed in the chat, I have been working on a prompt for Perplexity to help me analyze stocks. And I know a lot of people have been doing that, and I've seen some of your prompts. And I'm just going to tell you, they are way, way too simplistic. The prompts that I have for Perplexity so far is a page long in a Word document. I need to put in there about 100 sources that I want Perplexity to check. Might be 200 sources, I don't know, working on it. And I think the 1-page prompt probably becomes a 2-page prompt because there are certain things that I want in there that are not yet in there. And as I read the results that I keep getting, I'm like, oh, well, let's pull this off of our checklist, put this in there too. Ultimately, what I'm looking for isn't just a summary and a SWOT and a bull and bear case. I am looking for the things that the market is missing. I am trying to find what Charlie Munger always talked about. I'm looking for value that the market is not pricing in. Sometimes that is a piece of real estate. Sometimes that is a cash flow that is misunderstood or overlooked. A lot of times it is small and mid-cap companies that are on the verge, but the analysts don't want to write about it because what if they're wrong? Buffett called that the institutional imperative, right? They'd rather jump on the bandwagon when it's moving rather than, climb in the back while it's still holding still. And there's value in that. However, if you're just going to jump on moving prices, you might as well just be a trend trader and be mostly technical. And that is something that over the last 3 years, you have seen me become more of a technical adherent. And this coincides with the fact that there are so many more traders. These technical trends in the market, which usually come with an accompanying narrative, are strong. The trend following is strong with this market. So I've always told you, avoid the middle of the market. And really, that comes from, picking things in the middle of the market. You can jump on a trend, though, and ride it. Just understand that you're going to have to jump off at some point. And whether you're thinking in 5 waves with Elliott Wave, or any other type of technical analysis, understand that there are rallies and pullbacks. And if you have jumped onto the last rally that a stock is going to have before a series of pullbacks, 1, 2, 3, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 6, 7, 8, 9, right? Because those are patterns that recur, then you better know a lot about the company you're getting invested in. Because if you jump in late in a trend and it turns against you, which happened to me in 2021 a couple times, this market can move things fast. If you haven't wrapped your head around the absolute fact that these markets move faster and more severely post-COVID than they did before, combination of the monetary manipulation in the world that just keeps accelerating and has been since the financial crisis, and the fact that there are twice as many traders as there used to be. Think of that like Las Vegas. Las Vegas a year or two ago was packed. Suddenly Las Vegas is slow. I think that the stock market's a lot like the casino right now. Everybody's having fun. There's a lot of complacency about risk. There's a lot of arrogance because people maybe doubled their money this year. I think there's a lot of round trips coming up. A lot of people are going to give a lot of it back. If it is just a run-of-the-mill bear market like 2022, that was hard enough on people, but it dragged on for about 9 months, and a lot of people lost 20 or 30%. Again, that's my base case for next year. But if there's a credit crisis, we could have a month or two that is elevator drop, elevator drop, elevator drop, limit down, limit down, limit down. And that could be another 20 to 30% down fast. If that happens, don't lose your mind. And if you're concerned about it, having cash secured puts rolled off every month is probably a pretty good strategy. And having 10 to 20% of your money in cash on the regular, pretty good strategy. I think, and I haven't said this in a long time, right? That's the preface that you should perk up to. What is Kirk about to say? I haven't said this phrase in a long time. I think that somebody might be able to guess what I'm about to say. In January, I might say, what might I say in January? 3 words. Well, you guys are close. There you go. Stefan got it. Not sell everything. Sell almost everything. You always have to keep some exposure with your best ideas. If we get a blow-off top in Q4, you're really going to want to sell into the January effect. What is the January effect? The January effect is essentially a ton of money from retirement plans that flows into the stock market, right? All the matching, stuff like that. And it actually, is one of the main reasons why the first quarter is usually pretty good, right? A lot of retirement plan money, a lot of new budgets, both at the personal and institutional level. So I don't know that this is going to happen. Nobody does. So all those services out there that just brag week after week after week about the things they get right, they just sweep away the things they get wrong. Keep in mind that you heard here that if we get a blow off top into January, you're going to want to be big sellers. I think I'm going to end up selling a lot of January covered calls. That's what I think. So we'll see. All right, let's take a look at a couple of names here. Arrow. This is one that we've been scaling into for a few months because they are one of the key drone makers for NATO, and they just did a strategic partnership on manufacturing. This is a company that has a partially busted IPO, right? They're down from their IPO price earlier in the year, but they are on the verge of beating earnings in the next quarter or two, probably by a lot. The all chart patterns algorithm is pointing to a price of 32. Right now it's 18. I have a half position in this stock. I also have some cash secured puts sold going forward. If it happens to take one more dip down below 1750 between now and January, I can have more assigned to me. I actually closed these 20s for a profit a while back. I think the Arrow is a pretty good buy right now if you're looking for something to play a rally in the fourth quarter. I think that long term, they have a lot of upside. I think they are a takeover target. Somebody mentions that their lockup period ends December 9th or 10th. Maybe those are a couple of good days to do some buying if there's a couple of days of selling pressure. I don't think anybody's too terribly interested in selling this stock that owns it. I think traders throw out narratives. I think the narratives are usually opportunities to go the other way or to ride a trend. There is no trend here. It's just been a drift, lack of interest. People have been in other drone names. Drone stocks that have gone up way too much for what their earnings are going to be. And this is one of those companies that has been ignored a little bit, even though they're one of the companies that are going to have huge contracts going forward. We already know that. I mean, we know that. Not a speculation. We know that NATO is ordering a lot more of these drones, and they were just constrained by their production capacity, which they have now done a joint venture to solve. This is where knowing your companies comes in. Doesn't mean the stock price can't go down because traders say things like, hey, there's a lockup ending. That's known information, which means that maybe the sell-off already happened. And if it hasn't, it'll only be a couple bucks. Who cares? Enovix, I believe, announces earnings next week. This is another one where the algo is saying it can shoot up. This one has been getting a more positive narrative in social media and from institutions. At the social media level, the trader level, the blogosphere, the exaverse, it's kind of mixed, right? It's a battleground stock. There are definitely some shorts in this one. But this is another stock that can jump quite a bit. What do you think the market is missing with Enovix? What do you think the number one thing is that the market is not pricing in right now? And it's gigantic. Who are the biggest battery makers in the world and cell phone makers in the world? Think about that. So who would it make sense to do a deal with? Who could really materially move the needle on this stock if this company had something to do with their batteries? Right, Samsung. So Enovix already has a deal with the company that helps make Samsung batteries. And they've gotten the key certification to expand that relationship. So not only do they have a battery for lithium that doesn't burn, but they have a deal with Alentech, which is the company that Samsung has make its batteries, or I don't know if that's the exact right way to say it, but that's a component company for the battery packs for Samsung. Essentially, what you're seeing is the potential that Samsung is going to flip all of their batteries over to the Enovix design because they run cooler, they don't catch fire, and they have a longer battery life, and they discharge just as many times. Kind of the holy grail, right? I don't know when an announcement could come, but there's a reason why Enovix is dramatically increasing their battery production capacity. And remember, this is licensable technology. If there's existing battery plants out there that are running light because of the switch to a new technology, they can just license this technology out to them. Talk about an asset-light model in a typically asset-heavy business, right? Lower CapEx with all the profits. They may not have to put $1 in to get $2 out. They might just have to sign their name. Maybe they have to split it. But so what? As Les points out, they are on the verge of having batteries in America too. Remember, TJ Rogers, he's got connections. TJ Rogers is the guy that you need, right? Cypress Semiconductor, Enphase, now Enovix and SunPower. I don't know if I've pushed you into buying this yet, but if I haven't, I don't know how much time you have left. Because when this channel changes, right? Here's the channel. Let me get rid of some of this stuff. Yeah. See how that's kind of chopping along sideways? We like choppy sideways, don't we? It usually means it's going to break out. This whole thing will pivot to an upward trend. Algo says a price way up here. Fair value gap is here. This is really where you'd expect institutions. It's called an institutional fair value gap. Institutions probably pull the price into here. And then everybody that comes later FOMOs it up. SunPower, the chart doesn't matter. It's just cheap. I've just been buying that. And again, I think that some things that make sense, actually things that make sense eventually happen. The harbinger here to me on SunPower, on Enovix, battery storage, is what's going on in government. They did not get rid of the battery incentives in the tax code. They're making manufacturing easier. Less regulatory scrutiny. They're going to pollute more, probably. It's actually good for the investors, just bad for everybody else. And the lithium mines. If you really wrap your head around the fact that the Trump administration wants to own some of Lithium America, company that I told you about a couple of years ago that made sense to me as a strategic asset. You know, I don't like the man, but everything he's doing isn't wrong. And I think that the one thing about the Trump administration that you can say is that they make it really easy to follow the money. So get over any of your dislike or hate or whatever. You know, you can keep it on the side, but keep it out of your portfolio because you can really follow the money here. And the fact that they beat up solar and wind together and then turn around and bought a lithium company, or got a piece of it, I should tell you something. The no-brainer move of the energy system is to have solar power like everywhere that's commercial. All the new factories. I mean, it's going to take 10 years to build them, but so what? It is a no-brainer for industry and commercial to have solar and batteries. Just a no-brainer. And the data centers, which they're already doing it. Right now, solar is something like 10 or 11% of power in total. It's a lot more on a daily basis when the sun is out in a lot of places. Elon Musk has said that solar can power 80 to 100% of the global economy at some point. I think 80% is high, but I think we probably see that in the next decade or two. So that means that is just a gigantic total addressable market. And it has to happen, because even though oil is pushed down right now in a little mini supply glut and the narrative, it will get more expensive over time because there's just, not enough cheap oil to get to. We've already gotten most of the cheap oil in America. We've known that the day for that was coming in Saudi Arabia, though their version of cheap and our version of cheap are different. Cheap oil in America today, starting with a new well, is still going to run you over $60 a barrel with all the sunk in upfront costs. There's really not anything left in the 40s, maybe a little something in the 50s here and there. Saudi Arabia and OPEC in general, the reason they're expanding their footprint again, the reason why they're increasing supply is because they know that we're on a plateau for production. We're hitting it right now. Been hitting it for about a year. Maybe production goes up 1% or 2% for a year or two, but we're pretty much going to be on what I have called the peak oil plateau for the next 5 to 10 years. That gives OPEC a lot of pricing power, doesn't it? So you have to go back to the pre-fracking boom era, to the financial crisis and back, and study that, because you'll understand that at some point we probably get a 3, 4, 5 year run where the price of oil is $80 a barrel or higher. It might even be mostly permanent. One of the companies that we are going to take a look at here is Saudi Aramco. I think this is the right symbol. I think that Saudi Aramco is probably going to do very, very well going forward. I'm not going to invest directly in it. I just want to overlay something here. Let's change the color. There we go. What color do you associate with Saudi Arabia? Should we go orange? Let's go orange. I think that as this goes up, right, they kind of follow each other, but there's been an opening of alligator jaws here. I think the trade is to buy them both, and then when Saudi Aramco starts to catch up again, probably sell it. I really like KSA. This is the Saudi Arabia ETF. I really like this for a breakout. I just don't think there's much downside. I know that nobody really likes what's been happening in Israel, but I think that one of the likely outcomes, aside from clearly probably some terrorism, is that the Middle East is probably going to settle down a little bit, at least for a while. I think the Iranians are on alert. I think they understand that we are not going to be shy about bombing them. We're not going to be shy about killing them. So you can argue the ethics and morality of everything that goes on all you want, but it is clear to me that the might of nations here, that the force of power is going to line things up for the United States, Saudi Arabia, Israel, and there's money to be made. You can decide if you want to invest in that or not. But I think that Saudi Arabia, just by virtue of being super rich, basically having our technology at their disposal at this point, and apparently our military, is probably going to make a lot of money. I would expect the price of oil to stay low through the midterms. I have no idea what happens after that. That means that even though I like the oil stocks that produce gas over in the Delaware Basin, you haven't seen me really pile into those. I have the Katera petition, but I've sold some covered calls on that, right? Got the January covered calls. Permian Resources, I don't think it, has some expire, some puts expire. Have a half position there. If it goes down anymore, I'll probably have to buy more. And they have a huge dividend. So for those of you who love dividends, oil and gas stocks are great places if you pick the right ones. There's a chart out on the internet the other day. I'll try to find it and put it in something. It showed the amount of money made per employee of the company. Which oil company do you think makes the most money per employee? It's by a lot. Just showed them to you. Saudi Aramco. It's not even close. Exxon and Chevron are way after. Then all the other majors are after them. You can do the same analysis for these other companies. The mid-tier companies in the Delaware Basin are starting to make more money per employee because of the gas getting to the market finally. So I do think there's a contrarian bet on oil and gas stocks, Delaware Basin in particular. I don't know how long it takes for that to play out on the positive side. Might not make a lot of money on them until the end of next year, but you might get your price here soon, say by spring. Remember, they usually start to rise going into the summer drive season, but that relationship has become less pronounced since COVID. So I really am not considering it very much anymore. It used to be a cyclical thing. It's less so now. Been taking a look at cybersecurity. I'm going to do a full report on that here soon before I leave for Arizona for a week in 3 weeks. Cybersecurity is interesting. If you were paying attention today, they're saying that the Amazon thing didn't have a lot to do with cybersecurity. I don't know about that. What I do know is that the use cases for cybersecurity are changing rapidly as the edge of the cloud, the edge, becomes more important, as AI becomes more ingrained. Take a look at a company like JFrog, and you start to see that they might be very easily disrupted. I think that's a company that get bought out for roughly its current market cap because I think the threats to JFrog are real. I don't know that their tech is in a position to win a lot of business with the hyperscalers anymore. And one of the hyperscalers might just say, hey, let's integrate you and give all the executives a golden parachute. So they're coming off the punch card stocks list. SentinelOne, on the other hand, is one of the best AI use integrated AI with their cybersecurity. And that's a company that could be bought as well. But I think it's a company that can also continue to exist on its own and take market share. It's different than the container company, which is what JFrog is. I think that some of the big cybersecurity companies actually are going to have a hard time growing anymore. I think the integration of AI with cybersecurity at the network level, at the cloud level, is going to accelerate. So I've been going through all these companies, and cybersecurity is more necessary than it's ever become, but I don't think it's the place for small companies to grow. I think this is another case, and I hate this. You know I hate this. I think this is another case where big just gets bigger, and they either crush or eat the small guys. I could be wrong, but if we get a correction in QQQ, I'll have to buy it. I do think there's M&A coming, though, because this administration is going to allow it. So where we can find M&A that'll get bought with a premium, because not all M&A comes with a premium, those are interesting. And that's why I like SentinelOne. I think that SentinelOne has been putting in a nice consolidation pattern. I think that it got pulled into this fair value gap. I think the narrative is going to shift. And it might just get bought out. If it gets bought out, I think 2 to 3 times the current market cap is where it belongs. It's trading in the 5 billions. I think it's 10 to 15 billion all day long. Again, not a 10 bagger, but if you have an obvious place where you can double your money in the next few years, I think that's probably where you go. They're on the verge of profitability. They have a good balance sheet. If they beat their next earnings, I think it goes, especially if we're going to get a blow off top of the market with market breadth expanding. All right, I think we've covered enough. Anybody have any easy questions? No hard stuff. My coffee's not kicked in yet. I think it kicked in and now it's kicking out. All right, so let's call it a day. I will finish the options expiration updates. To anybody who is living in the Arizona area, I know there's several of you, the 18th, 20th, and 21st of November, I'm going to be out there. Those are days I'll have free. I am scheduling one appointment with a client, but then everything else can just be meetups. So I'll be out for breakfast those 3 mornings. But yeah, I'll be staying in Chandler, right next to Intel. But yeah, if you want to get together, just let me know. Contact me through the chat room, appropriate chat room, or direct message through the chat rooms. By the way, I'm really not using the email anymore, so I'm trying to strip it off everything. We have direct messaging through the websites, so that's the best way to get a hold of me. All right, take care, everybody.